Welcome back. Today, I want to give you an insider view of how sell-side equity research works. Make sure you watch until the end so that you understand holistically how different players fit into the ecosystem. This knowledge will help you stand out during an informational interview or a real interview. If you're new to my channel, I'm a full-time career coach and Instagrammer who runs the account, Dig the Sell-Sider. Let's dive in. So how is the sausage made? I'm going to show you the whole process from content creation to report dissemination to institutional investors. And I will use the initiation report as an example, but the process is similar for all report notes. I will explain later what an initiation report means. So the research team are the upstream. They are the sources of content. They produce the research reports and create the financial models based on management guidance, macro data, and historical financial data of the covered company. Per regulation, analysts are not allowed to speak on their views on stocks without publishing reports that contain that view first. Therefore, every time analysts join a new firm, they will initiate on stocks they intend to cover, also known as launching a coverage. The initiation reports are the detailed reports that describe the business, competition, products, market size, investment thesis, etc. After the reports and financial models are finished, they are sent to supervisory analysts, or SAs, for review. The SAs are the biggest impediment to report being disseminated, so they are wildly disliked by everyone in equity research. But they're also a staple feature of the profession. For example, SAs will check to make sure reports do not solicit investment banking businesses, such as speculating on mergers or acquisitions not confirmed by the press, or that the reports do not contain provocative languages, and things get subjective really quickly here, and that's when research teams frequently get into shouting matches over email with SAs on what's the right wording, why is that inappropriate, and when it's 11:30 p.m. at night, no one wants to deal with that, but your motive is to get the note out, so typically we concede to the supervisory analyst. Every single equity research report needs to be approved by an SA before it's published and disseminated to clients. After the initiation reports are approved, the analyst will tell a function called product management that she will go on the morning call to market the product. The morning call is a daily meeting that occurs before the stock market opens. During the meeting, research analysts who are scheduled to appear will take turns pitching their high impact research, such as initiation, deep dive, key stock upgrade and downgrades, to an audience called equity salespeople, so that salespeople can promote their research to institutional clients who are mutual fund investors or hedge fund investors. For more routine research reports, such as earnings recap notes, analysts don't go on morning calls. So during this process, two additional constituents are involved. Product management, they manage the morning call process. Every day they decide whom to let on the morning call, because every analyst thinks every research report of theirs is high impact. Product management also provides guidance on best practices for research reports based on client feedback. And finally, product management keeps track of readership metrics, and they manage the firm's annual institutional investor II polling process. Then there's equity salespeople. It's in the word, they are the distribution channel. They attend every morning call because that's when they receive the products that they can sell to clients for the first time on that day. If sales knows an analyst stock upgrade before the report is published, that is the same thing as having access to insider information. You will lose your broker license, and that will probably show up in the news as well. So that's why there is a morning call process. The note needs to be published first, and then it gets marketed first internally to equity sales, and equity sales will market your product to external institutional clients. Salespeople have their coverage of client accounts. For example, Hannah covers 5 industrial pods and a mega single manager hedge fund, while Josh covers technology portfolio managers within the long-only mutual fund and a few 200 million asset under management long-short hedge funds in Boston. When I first started in equity research, I wondered why salespeople existed on the trading floor. All they do is on the phone with clients every day, wine and dine with them, and scheduling calls. What is their value add? But it didn't take me long to understand why equity sales are absolutely essential feature of equity research. Equity research liaises between the research analysts internally and external public equity investor clients, and they add value in the following ways. An investment firm of decent size gets emails from 30 plus sell-side research firms every morning. Let's face it, do you read all the free newsletters that you subscribe every week? It's the same way on Wall Street. Buy-siders are not reading most of the emails. And that's where equity salespeople come in. After the morning call, they will call their portfolio manager clients to deliver the idea pitch in hopes of generating readership for a research report and arrange a paid call with the analyst who published the idea. So equity research is definitely not a if you write it, they will come profession. While some smaller hedge funds will never become a top client, some will become the next mega fund. Sell-side research analysts just don't have the bandwidth to build intimate relationships with all the hedge funds out there. Salespeople provide that attention to smaller funds. Shocking fact, smaller funds want their existence to be known too. Whom do you think the small fund will allocate trades to when it does become a top client? Every buy-side firm just invests a little differently in the stock market. And this makes it very hard to have a one-size-fits-all idea. Sell-side analysts are motivated by growing their audience count, but different clients want different things. Salespeople must exist to repackage research to appeal to different clients, even if it's the same product under the hood. Only if a sell-side analyst pitch an idea that fits the filter of a salesperson's client base, the salesperson will then funnel the idea to his clients, thus improving product market fit. Over time, salespeople know what his clients want, and that further enhances the client relationship and drives trading volume and thus commission for his firm. So these are the reasons why equity salespeople are very crucial in sell-side equity research ecosystem. To me, a simple industry structure analysis, like how I analyze every other industry, should explain pretty well what it actually does. I think of it as a two-sided aggregation due to highly fragmented nature of its two key constituents, investors and companies, who are also known as issuers, who issue debt or stocks for which the investment bank can provide a service for a fee. So on the investment side, there are tens of thousands of equity investment funds out there. Smaller investment funds can leverage equity research function within an investment bank to access management of publicly traded companies of various sizes. Without equity research, these smaller funds would not receive the management access because companies want to prioritize their internal investor relation resources on serving the largest shareholders. This is why research analysts host their own client conferences where clients get to do one-on-one sessions for a fee, of course, to meet with CEOs of companies they're researching. And flip it around, for companies, yes, we all know about the S&P 500 companies. But there are many more companies with lower market capitalization who need investor attention. Equity research function provides that reach for these companies. Even S&P 500 constituents wouldn't mind relying on the sell side to reach a broader, fragmented group of investors who can be an incremental buyer of their company's stock. As mentioned before, there is only that much an in-house investor relation department can achieve. So, what value does the profession really add? Why is sell-side research the way it is? I think from the vantage of an outsider, or even those in the industry, I've worked in the industry for a few years, a lot of things still don't make sense to me. I think the incentives are what made sell-side equity research how it is, and how it has been, and how it will be. The profession is not in the business of generating alpha. If you aren't aware of that already, I'll make that clear here. Some do differentiate by stock picks, but most add value via other routes that are less stressful than being right on stock picks. There are analysts within sectors that even the best buy-siders respect what they say, but they are rather the outlier than the norm. I think deeply about it, and I think some of the equity research value add is as follows. One, it saves time for buy-siders. Two, they provide corporate access, analyst conferences, non-deal roadshows for smaller clients to have access to these companies' management. Three, there is the dark side, which is promoting the issuer or the covered company. Even most outsiders understand the role Wall Street equity research, especially senior analysts, plays in winning IPO deals for her investment bank. So there is no misconception here. If this is your first time to my channel, please like the video and hit subscribe and the bell icon to make sure you don't miss any of the awesomeness that happens here. You can find additional resources on my website and on my Instagram. The links are in my profile and in the video description below. Please check out my previous video if you want to learn more about my background and hear my answers to some of the most frequently asked questions about sell-side equity research. I'm going on vacation for 2 weeks, so I will talk to you then when I'm back in early November. That's it for this time. I'll talk to you next time. Peace.